Hi everyone, hope you're doing well. Today we're going to do the most popular video series on the YouTube channel, which is the UK stocks I'm buying October 2025. I cannot believe it is nearly October already. And it's always strange when I come back to the whiteboard. It's like very rare I film a video now with the whiteboard. Maybe I should use it a bit more, but yeah, we're on the whiteboard as well for a little bit of a change. And not that I use it in the videos. But yeah, we're going to get onto the UK stocks I'm buying October 2025. We're going to go through all the stocks that I've been buying from the 1st of September to the 1st of October. So it just keeps with that transparency, because any move I've made, buying or selling, they're on this video series here. That's probably why it does so well. It's just the transparency aspect of it. I cannot hide. Every move I make is on this video series, so you can go back for many years now and see if they worked out or if they didn't work out, because all the videos are on the YouTube side of it. Do it a little bit different to other YouTubers that only come on here and they start bragging about things when they've already worked out. Not here. I'm telling you in real time, so then you can judge me in a few years' time if they do work or they don't work. And everything I am buying is for the long-term hold. I'm holding them for around about 2 to 5 years, and I aim for 100% return while buying these stocks. Apart from that, I hope you enjoyed the video. If you're new around here, subscribe. We are getting close to 20,000 subscribers, so if we can hit that by the end of the year, that'd be absolutely amazing. Let's get started on today's video. Now, before I do start the video, if you do want to see more exclusive content from me, get to see my buy and sells in real time, and also join a Discord with 600 members to talk about stocks, including me. Links in the description to join the Patreon, guys. You get all of those benefits for £6 a month, the price of a coffee. Not too bad at all, and you also support the YouTube channel so I can make these videos for you guys. And if you do want to start investing, join eToro, links in the description. I'm currently a popular investor on there, so you can track along with me on eToro as well if you join with the link in the description. Now we're going to start off with the sells today. We're going to start with the sells because the last couple of months have been pretty good going in the UK portfolio, and a lot of people always say don't buy UK stocks, and the last few months have proven exactly why you buy UK stocks, because there's been some fantastic gains locked in. And as well, there's been a lot more selling really than buying. Previously a couple of months ago, quite aggressive buying a lot of UK stocks. The UK buying has kind of slowed down a little bit at the moment, and the sales have been actually increasing, so that's been pretty good to lock in some profit. Starting off with the first stock that we've been doing a little bit of a trim on is Gaming Realms. So this has been a good performer for us this year, up 35% year to date, and obviously outperformed the S&P by over 3x. I did lock in some more profit, 35% profit and a 26% profit trim on Gaming Realms. The reason why I did trim some Gaming Realms is because the last earnings I thought were actually a little bit disappointing from Gaming Realms. We've seen a little bit of a downgrade on the EPS guides here. I also didn't like the revenue slowdown. I don't think there was enough clarity on why that revenue slowdown was happening so much. And then also what makes me a little bit nervous is potentially the budget coming up. I think that we could see gambling companies hit quite hard in the budget. So because of that, I decided to reduce my Gaming Realms position. I am on the fence about actually selling out of my Gaming Realms position completely. The only thing that's really making me think of do I carry on holding the position at the moment is that even on next year's numbers, we're down at 14 times earnings. The revenue growth is expected to grow at 10% and the profit to grow slightly faster, which I still don't think is a bad valuation. I'm just trying to work out at the moment about, I've been a little bit disappointed with the management team, a little bit disappointed about the communication there, and also some concerns about going forward around the potential government changes and also the lack of iGaming states coming online. So I am having a little bit of think on Game Realms if I do reduce that a little bit more. Obviously, if I do, you guys on the Patreon will be the first people to know about that. The next one is Audio Boom. So I did also trim my Audio Boom position. The last year, what a performer this has been. I still am quite surprised to see how silent it is on Audio Boom in the comment section. I'd expected a stock that is up around about 127% in the last year. And since I first started posting about Audio Boom, the stock has gone up 120% since I did my first videos back in December about it. I'm surprised not many people are actually talking about this as much in the comment section, but it's been an absolute cracking performer for us in the portfolio. I did lock in a 77% profit on Audio Boom. Not that there's any concerns with Audio Boom, it's just that it's ran up so much, and as we've seen with Audio Boom, the share price can be quite volatile on it, and because of that, I'm locking in some money. We're here to make money at the end of the day, and that's what I'm going to do, so that's why I did take a bit of a trim in Audio Boom for a 77% gain. The next one might actually surprise a few people, which is Card Factory. I did actually trim my Card Factory position by about a 30% profit trim. The reason why is because the last 6 months it's actually been on a good rally. Since about April time, the stock has rallied up around about 34% since that time frame, and it's been stuck in a little bit of a range at the moment, Card Factory. It drops down to that 80p range, and then it seems to have this bounce up every so often to this £1.10p range. And I thought, okay, we'll top that range a little bit. I'm here to make money. I've not really locked in that much profit off Card Factory over the last couple of years of buying. So let's make some money on it, lock in a bit of profit. And as well, this week we actually have Card Factory bringing out their interim results. Last time they brought the interim results out in 2024, that happened, as you can see here. And I'm going to lock in some profit. Even though they've told us once again the profit is going to be heavily H2 weighted, and they did that last year and then they proved it right, and the stock is really not being back to the same levels as it was previously. I just think the market, I'm worried the market's going to poo itself again, really. So that's why I'm also taking a little bit of profit off the table with Card Factory. And that moves us on to the stocks I'm buying. There's 5 stocks on the list. Technically, really, there's 4. I did buy 5. I'm going to tell you the 5th one, although I'm a little bit disappointed after I bought it. So yeah, I'll come into that when I do get around to it a little bit in a second. First one though, B&M. You knew this one was going to be on the list. I'll keep this nice and brief because literally 2 days ago I did a video on B&M that was about 16 minutes long, and that will go into B&M a lot more detail than what I will today. For you guys that watch the videos regularly, I don't want to bore you with a lot of more detail in B&M. Just a brief facts on B&M, why I'm buying it, and then also I want to add in one thing that I've seen mentioned about B&M, which is not true at the moment, and I saw that actually on the comment section when I did that video the other day. So B&M, it slumped in the first part of September down to £2.20 range. No idea why, because I thought B&M have actually started to move up in the right direction. You get a 5% dividend yield with B&M. They've got a new CEO coming in, and from what I've seen at the moment, the things that he's putting in place have actually been driving a lot of success with B&M at the moment. The CEO has been buying a ton of shares at the moment, and also if you look at the last update was a step in the right direction as positive quarter like-for-like trading performance started happening with B&M. Look at the valuation that it's at the moment as well. I'm thinking B&M actually looks a very interesting stock to be buying. Now, any more detail you want on B&M, like I said, go watch that video here. But I just want to, I was going to do an actual separate response video, but I thought, you know what, I can just do it on the stocks I'm buying video series. So I've seen a lot of negativity about people saying that, oh, the only reason why the CEO is buying so many shares, obviously, you know, when a CEO buys some shares, it's normally a positive sign. You know, why they're buying some shares? It's because they think the stock's going to go up. And obviously, we've seen the CEO, I think, buy around about 1.3 million worth of shares, which is obviously a very significant amount. And the comment that originally was on here, actually I think the person deleted, because I did reply to the comment, because I don't think it's true. So I don't know where it's come from. I think I know where it's come from, but I won't say who it is. They've basically been saying the only reason why the CEO's been buying that amount of shares is because he has to. And that's simply not true. If you look at the annual report at the moment, what a lot of people are referencing is that the CEO has to maintain 200 and 175% of base salary of shares. And that's in the last annual report. Now, the thing is that was under the previous CEO, so we don't know if that's going to be maintained going forward. And it would be very harsh to say you've got to go buy that amount of stock after coming the CEO. So that was last year's, so don't get confused by that. And also, it probably would have been disclosed on these RNSs as well, that the reason why is to meet that threshold. The other thing as well is like they're not going to go to a new CEO and go, right, in the next 12 months, you got to buy a 200% stake. That would be pretty hard to do as well. So they're probably going to redo this for the current CEO, because otherwise it would be really harsh for that to happen. And let's say that we haven't been told in the RNS that this is what he's having to do to reach this 200% threshold. Well, the fact that he would have a year to do this, and he's literally reached the threshold within the first 2 months of being a CEO, shows significant signs of, okay, I think that this stock is very good value right now. I'm going to build up my position very quickly in case that stock, I believe the stock could do a very quick recovery. That's what I'm reading into it. Now, like I said, the other main point that I missed on here is that if you look here, that if they don't build up a 200% stake in the business, the thing is that what they have to do is they have to retain 50% of all shares under the deferred bonuses. So they don't even need to have a 200% stake maintained. It's just that if they don't have that, they just all the shares they get awarded as a bonus, they have to keep 50% of it. So this is one of the negatives that I've started to see being used against B&M, which isn't true. So yeah, that's B&M anyway, and quick thoughts on that one. Right, number 2, getting on to the next one, Watch the Switzerland Group. Watch the Switzerland Group had a big sell-off since June time. You can see here there was the tariff situation, rebounded, and then it's fallen down basically to the tariff lows. Maybe the nerves is around potential trade deals, around situation and tariff impacts going on at the moment. I think this is just way too overblown, because what Watches Switzerland have done in that time frame is they've come out and said, like, hey, everything's actually going quite well. And since the update, since they've done that, there has been a little bit of bounce up in the stock. In my opinion, not enough to where it should be. And it's still way below where it was when it came in at the start of the year, falling a significant amount, and still way behind where it was in 2022. Now, what I like Watches Switzerland for is because it's really the only way you can publicly buy or invest in Rolex. Rolex do not sell directly to the consumer, and they're not a public company. The one way you can really get around that is by buying something like a Watches Switzerland Group. And if you look at the share, what the price of Rolexes are, they had a big surge in 2022 when there's all that free capital, people were at home, they had all that money to spend. And since then, we've had a bit of a pull forward in demand, and there's been a bit of a pullback. Now, since that pullback happened and it started to stabilize in 2024, we now have the U-shape starting to get built up in the Rolex prices. And historically, Rolex prices do maintain the value, and they historically keep going up as well as the value of Rolexes keep performing. And if you look at the AGM update that we literally got in the 3rd of September, you can see here that the first line is, we are pleased with our performance. We are on track to deliver a good H1 in line with expectations. We have consistently seen strong trading throughout the period, particularly in the US, which is also key. We'll get that onto in a second. But you can see it, they're coming out and saying, look, we're in line for expectations, and they're actually using the word strong as well at the moment. And the big thing is with the US side of it, that's a key driver for them, because the US has become a major part of the business since 2019. Previously, the US was 185 million of the business. It's now 786 million, and in fact it's just overtaken as well the UK business as well. So that is going to be a key driver for them going forward, as we know the US has a bit more money to be spending on these luxury watches. Now, the only thing I'm a little bit disappointed with Watches Switzerland Group recently is there has been a couple of downgrades on the EPS on the side, but still the revenue growth is still forecast to be pretty strong, and we are expected net profit to start bouncing up to good levels, trading about 9 times this year's numbers or 8 times next year's numbers. Watch the Switzerland Group as well has historically been a lot higher valuation. It's not, as you can see here, 15 times earnings, 17 times earnings, 25 times earnings, 33 times earnings. I would say the publicly only way you can buy really Rolex is normally premium. I would argue the case that something like a Watch of the Switzerland Group should be around about 20 times earnings. And even if you don't say 20 times earnings and you go something like a 17, 18 times earnings, well, that's still significantly higher than the 2027 forecast on a forward PE. So I am liking Watch of the Switzerland Group at the moment. Moving on to the next one, which is Greggs. So I only recently became a shareholder in Greggs around about a month or 2 months ago. So for these guys that have been in the stock since this time frame, sorry about that, but obviously it's created an opportunity for new investors to get in, and I'm currently a new investor into Greggs. It stayed a bit stagnant on the share price recently since I've been in it, so I'm literally about break even on Greggs. You do get a lovely 4.3% dividend yield on Greggs as well, and I do want to be a little bit cautious here because on Wednesday they are actually bringing out their Q3 trading update. So quite often when I do these updates, they can go out of the news, and the numbers that I'm using go out of date very quickly and time sensitive, so just be aware of that. But Greggs, obviously, if you're from the UK, you know what Greggs is. If you don't know what Greggs is and you're from the UK, I think you're lying to me. You're not from the UK. Everyone knows Greggs in the UK. Even Americans are starting to know what Greggs is now. Yeah, they came out with an update a while ago. Well, the last kind of few months have been pretty tough for Greggs, as you can see here. They've had a bit of a poor time really since probably May time. The impacts of the NI have been hitting them. They say the warm weather's been hitting them and a few other cost pressures, and that's led the share price to start dropping a pretty significant amount. In fact, actually, you can probably pinpoint from around about where the budget started happening, where it just started to go so wrong for Greggs, actually, down 50% since that time frame. But I still believe Greggs is a quality business, and I'm buying it up because I think this drop is way overdone. A few people say Greggs is maxed out on locations. I don't agree with that, because if that was the case, you wouldn't have first half sales still going up 7% and like for like still maintaining at 2.6%, which is still not too bad at all. The problem that a lot of people are focusing at the moment is that pre-tax profits have been down significantly and EPS has been down significantly. Now, if you read the earnings report, there's a couple of reasons why they've been investing into the supply chain a little bit at the moment. They have overall cost inflation at the moment. Their finance income drop off a little bit. The effective tax rate went up as well. Obviously, we've talked about the NI impacts that have happened. And also, we have a lot of people talk about Greggs is obviously the stealing issue that's been going on at the moment. That's been affecting them. They're going to combat with trying to put that behind the counter. There's also the point of view that you have what Greggs have been saying, the warmer weather has affected them. I'm always a bit 50-50 on the warmer weather side of it, and if that's actually true. And, you know, all of a sudden we're blaming cold weather, then we're blaming warm weather. But there's definitely a lot of impacts going on with Greggs. And I think what's just happened is the last 12 months have just been a combination of where everything that could go wrong with Greggs has gone wrong. From the government changes, the tax changes, the thieving issue, and then obviously the investing into the business has come at a big time frame, inflationary impacts. I think it's just all whacked at once. And I think what you're going to see in probably 12 months, 24 months time, people go, oh, Greggs is actually still growing very well. It's still a solid business. Those things that went wrong for them, they've all kind of gone out now. You're lapping the comps here, and Greggs starts moving back up in the right direction. And revenue growth continues to carry on going well. We start to see the recovery in the net income point of view. 12 times earnings at the moment, but I think we start pushing back up to like the 150 million-ish, which will, you know, put you back down to 11, 10 times earnings. And, you know, while you wait, you get that lovely dividend. And as well with Greggs at the moment, you know, normally Greggs is a bit more of a premium company on the UK markets. Normally trades around that 20 times earnings, which I think is about fair for someone like a Greggs, around about 20 times earnings. Obviously, that metric expansion will be really nice from where it's at the moment. So we'll see if that happens with Greggs. Number 4, Barrett Redrow. So I have been adding into my Barrett Redrow. It has had a massive slump recently. You can see here that it's now pushing down to its Liz Trust lows, and it's actually below its COVID lows, which shows you like the negativity around the housing space in the UK. But I think the housing space is still going to do very well in the next few years. We know there's a shortage of houses, and the only way to sort that out is by giving more power to these house builders. And also when interest rate cuts finally happen in the UK, that will be a massive help for them. But there's a lot of other things going on with Barrett Road. So the other thing is that at the moment they've brought out some solid results. The profit actually came a little bit ahead of expectations, which was good as well. They also getting synergies. They did do a merge with Redrow, which is another 60, I think it was 60 million. It might be more than that, that they think they can save now by doing the merge with Redrow, so that should help them be more profitable once the housing market does recover. With Barrett Redrow, they are one of my preferred house builders. They generally have decent reviews, which is quite rare for new house builders, because obviously we know how much they get slated for. And the other thing about Redrow is that I actually... the designs, new house builds for me always lack a little bit of some enthusiasm, imagination when building them. But with Barrett Road, I always look at their housing estates. I actually always think, like, if I'm going to buy a new home, it would be Barrett House, because the houses and the housing estates actually have a little bit of personality in there, and the houses actually look very good. Looks like they haven't just been thrown up as quick as they can. So I like it from that point of view as well. When you look at also Barrett Road, we are expecting that revenue bounce back to start happening, which is kind of happening a little bit at the moment, but hopefully with more interest rate cuts, that does start speeding up, and we do start pushing up to some more decent amounts of profitability. Obviously, they used to get up to about 660 million in 2021 and 515 million in 2022. That was obviously before the merger between the Barrett Redrow on top, and then obviously you've got the synergies on top. So really, we're hoping when we start seeing this housing market start recovering, you go from the 513 million to 600, 700, 800 million. And if that does start having the case on a market cap of 5.4 billion, doesn't look too bad at all. I know a lot of people as well like saying that also it trades at price less than price to tangible book asset value as well, which a lot of people like to point out as well. And you also get a little bit of a dividend while you wait. And I think the balance sheet's also pretty decent on Barra Red Row as well, that I've not actually shown at the moment. And the fifth stock on this list is Warpaint. Now, I'm not going to go any further with Warpaint because I think you guys have seen my thoughts previously on Warpaint. So I did start buying at the start of September. Since then, unfortunately, the stock has had a pretty significant drop. They did come out with a financial update, and I thought the financial update was very poor from Warpaint. And because of that, I will not be buying any more of the shares. I'm currently holding what I did buy, and if I knew what I knew now, I probably would have bought the stocks or the shares that I did buy in September. A little bit frustrating. Obviously, we saw that the market was pricing in some form of profit warning. It's just the fact, I mean, I'll see if I can quickly find it on Stockopedia for you guys. It's just that the profit warning that did happen was way worse than even what the market was pricing in. So you can see here that there was a significant drop in the EPS, and what was probably more concerning as well is the profit, the drop in for 2026 numbers as well was a significant drop. So yeah, not happy with that one, and I'm not wanting to talk about that one anymore because, like I said, if I knew what I knew now, I wouldn't put it as a I don't want to feature it in a stocks and buying series, but I have to mention it because, like I said, every stock I do buy and sell, I do tell you guys, and I do talk about it from transparency reasons. So I will let you know I did buy someone, did buy some Warpaint. However, the facts have changed since I did buy, and if I knew what I knew now, I probably won't buy. And I don't really want to make it a big feature on this series because, the business has deteriorated a bit more from where I did originally buy. So I guess that is the 5 stocks I bought, or the 4 stocks I bought, really. So yeah, hope you enjoyed the video. If you could hit the like button. As I always say, if you can share it around in investing communities, that's all I ask for, if you could, for the this video that I do put together for you guys, because this one does take a bit of a while to put together. But apart from that, thanks for watching, and I'll see you on Monday for a preview of the week ahead.